Let's talk about today what allows most traders to be consistent and definitely a means of being profitable daily. Okay, we strive as traders each and every day to have a goal to make money in the business. Okay, and everybody has their own certain style of trading and strategy they use, and certainly, hopefully, you're using a trading plan that you are sticking to. You have a strict regimen of how you're trading and sticking to your rules. Now, the way I trade is all about multiple time frames, and the importance behind it is the reason why I wanted to create this video content today, because it's imperative. I truly believe that as a trader, you should be using a top-down analysis, using a higher base chart to kind of guide you and let you know the direction of the market and the direction of what you should be taking your trades in. And one of the biggest pieces to the puzzle, one of the largest and most important parts that's going to allow you or make the difference of you being consistent and profitable is understanding market structure. I keep talking about that. It is the binding glue to this whole thing. Okay. And before you get started, if you're someone that's new, that's watching this for the first time, trying to figure out which markets to actually trade, if you're going to trade futures or forex or options or whatever, just trying to figure out what to actually trade. Market structure, regardless of what market you trade, is imperative. All right, if you really want to understand and make it in this business, because you need to really focus in on, is the market making higher highs and higher lows, or is it making lower lows and lower highs? Is it breaking through areas of structure? If you're a supply and demand style trader, is the market receding back or pushing back, pulling back to a key area of supply or demand? Okay, and that's how I trade. But I'm using multi-chart confluence. Yes, I've talked about being able to trade from one a chart and trading supply and demand. But again, I talked about that for if you're someone that has a larger size account, you have more capital. Maybe you one that trades strictly from a 5-minute chart. Okay, I trade range-based charts, so I would probably be trading off of 120 range chart. I've talked about that in a couple videos here on the channel. Just recently, I've talked about that. But you have to understand the downside to actually trading from a higher base chart and strictly trading. I'm not gonna say a higher base chart like an hour chart or 4-hour chart. Maybe it's someone that trades a 15-minute chart or a 5-minute chart. I traded a 120. Okay. Is there any comparison? Is it comparable from a 120 range chart to a 5-minute chart? No, because you have to understand different style of charts or types of charts. They are calculated differently by the bar, meaning, with range-based chart, it's all about volume. If there's not much volume in the market, you're not going to see a lot of activity when you start moving up into higher base range charts. Okay, with 5-minute charts, say for example, or time charts, time-based charts, the candles are going to open and close every 5, 10, every 5, 15, half an hour mark or hour mark, whatever the case is. It's based on time, when that candle opens and closes. I like trading range-based charts because the market, we all should know by now, moves based upon volume. So using a higher base chart and trading specifically for, say, from a 120, can it be done? Yes, for someone that has a higher, has a larger capital to trade from. But you must also understand that when you're trading from larger base charts or higher base charts, time frames or whatever it may be, tick base or volume base, you have to understand this. That you may incur some drawdown, and if you have don't have much capital what you're trading from, you can actually blow your account fairly quick. So getting to what I wanted to talk about today was simply using multi-chart analysis and being able to depict the direction of the market, understanding and looking at market structure prior to taking a trade, and identifying and marking up on your charts. When I say charts, I mean using 2 charts for confluence and using your lower base chart for to scale down and look for a entry point, confirmation, or rejection. So, for example here, what we want to do, I'm using my higher base chart to start off with, okay? I just want to be able to see, is the market moving down to the downside? And these movements could be for a short period of time. You may have a bearish push to the downside, and that could be short-lived before it actually breaks structure back to the upside. And then the market is still trending to the upside. So, for example, like right here, the market pushed up, took out these highs here, it broke structure, broke structure again, taking these highs up here, and then, you know, it breaks structure again, and it keeps breaking structure to the upside. We're taking out highs on the climb to the upside, okay? And then as it's moving lower, okay, this is a bearish movement to the downside here. All right, this could be just a decent pullback. It could turn back around, you know, and this didn't last, but, you know, towards on the September the 19th, towards the closure of the market on that day, into the next trading session. And I've said this before, pay attention to what goes on in London, because a lot of times around 10, 11 o'clock, the market likes to reverse and then move the opposite direction. In this case here, London was bearish. You know, we get into the open of the U.S. session, and then the market does what? It starts moving back to the upside, and then we take out this high right here, this major high, to now we're breaking structure back, what? Above this area here, and we're back in a bullish mode. So even here, when it dipped lower right here, you can see where it pushed up, it pulled back here. We're breaking structure, taking these highs here out, taking these highs here out, a bit more structure, taking this area here out to the upside. So now we're back in bullish mode to the upside. Even though we haven't taken out this major high here, we are still breaking, making new higher highs and higher lows, breaking structure back above, okay? So, and then we have this nice area of demand resting right here. But here's another one too I want to share with you, because what I like to do is, in helping me decide and to get into and define or redefine my trade setups as far as entry points, I like to find a zone, meaning a supply or demand zone, from a higher base chart, my 120, and then just kind of move down to a 24 range chart, or maybe you want to use a 20 range chart, whatever it may be. Just when you start moving down, try to avoid to getting right down to, like, you know, lower base charts beyond maybe a 20 or lower, because then you want to kind of eliminate some of the noise. Okay, so what I'm doing is marking up a higher base chart first, and then I'm going to move down to a lower base chart to find my entry point. So if I'm looking for a demand zone and have it marked up off my higher base chart, then I'm looking for a demand setup within this area here, okay, the same zone. All right, or if it's tapping a zone like this right here, and then there's no zone within, then I like to see the market on the 24 range make a new structure break to the upside, creating a new area of demand and pulling back to an area of demand to take that trade from. Okay, so right here, you can see that on the 24th of September, all right, and there's loads of these types of setups you'll find across your charts. But first and foremost, always start with understanding and looking at the structure of the market. As you can see, we're moving to the upside here. We're breaking structure, pulling back, and then we're chopping, you know, kind of ranging here, but we're chopping back to the upside, making slight higher highs and higher lows, and then we break above this area right here at, what is that, 20,163.5, all right? Breaking that area structure above that right there. So we've created a demand zone resting below, okay? So pushing higher, making higher highs and higher lows, finally breaking structure above. Okay. Now, one of the key factors, one of the most important parts that I like to see, I must see. For one, I want to see break a structure. I'm not marking a zone unless we got to break a structure. For two, once we break a zone and we have a nice structural break to the upside, okay, in this case here, I want to see an unmitigated zone that's created off of that or came out of that structural break. Okay, we broke above this area here. So that just means if I say unmitigated, I mean an area where there's an actual gap resting back at the zone, okay? And there is right here. This first zone, yes, it did break structure here. It could have came back here, rejected, and pushed higher. But if you see here, when this bullish candle here closed, and the second one, it broke above this bearish red candle right here, it broke above the wick of it. This next candle, the third candle, when it swung back, it filled any type of gap back to this zone, all right? So you have to understand that. Before, it actually broke structure to the upside. So this area was already filled back to the zone. So that's a low probability mitigated zone. Now, if I go a little bit lower here and look at this next zone right here, this bearish candle here, okay, this is a swing to the upside. Bearish candle right here. The candle that broke was this bullish candle right here, the third candle above it. There's a small gap from right here, the top end of the wick of that bearish candle right here, to the bottom end of the wick of this bullish candle right here. It's a very small gap right there. So this is a high probability. It is already a demand zone, okay? Whether it's low probability or high probability. In this case, it's high probability. But this is a gap resting right here. So it increases the chances of a trade working out in our favor in which we can scalp. Okay, the market, we're already bullish back to the upside, breaking structure. That's the first part. Second part, is there any areas of demand where there's an actual gap resting at the zone to where we have a high probability zone right here? Okay, so there's a gap right there. That's 2. All right, and from there I'm going to mark the zone off, and then after that I'm going to move down to my lower base chart, my 24 range, as I have just done here. Move down to 24 range chart. This is the chart where all of the remaining part of the magic happens at. The market is retracing back, as we can see on the 120. This is that retracing back here to this area here where this unmitigated zone is at. This one zone with a high probability gap. So back down here, 20,052 area, right here, 20,052 area. So once it's tapped into the big box you see here, that's that higher probability zone. I'll mark them off the the higher base chart on the 120. So on this case here, once we tap into it, then I'm looking inside the zone to see, is there any area where there is a zone, demand zone within this larger box here, where there's an actual zone that has a gap at it on the 24 range chart. Yes, there's a demand zone resting right here. There's also one resting down here below, as you can see. So there's actually 2. Let me blow this up for anyone that's having a hard time seeing this. A zone here. So the larger box again is that 120 range, higher base chart, demand zone with the gap at it. Then we're just moving down to a lower base chart, and we're trying to redefine or just kind of zoom into so we can get into a better position, more of a precise entry point. By doing this, what this does is you're not taking a trade strictly off of this chart right here. And there's nothing wrong with doing that if you can, and if you have the size capital, you know what you're doing, you know the direction of the market, you see it's bullish, you see this beautiful area demand resting back here, and then I talked about waiting for the candle to close above and taking the break and then going long, right? Yes, you can do that, okay? But again, you have to understand that if you take this trade off of this rejection here at the higher base chart and it closes above, there could be some drawdown to where this candle right here is typically about 30 points, that one little candle. So if that market comes back 15 points, are you going to be able to weather the storm on that, with not having much capital in your account? You probably won't be able to. Someone with a larger size account that knows what they're doing and has been trading for years, you can see things like this unfold. You can sit that out and weather it out and wait for the movement to move in your direction. Okay, that's the only downfall about trading from a higher base chart directly, is that you're going to probably incur most times some drawdown before it moves in your favor. So this is the purpose and reason why I like to move to a 24 range. 2 things: multi-chart confluence. Okay. Or if you want to say multi-time frame confluence, okay, for those that may trade time-based charts. When I say multi-time frame or multi-chart confluence, it's the same thing, okay? We swing back to this area here, and I'm just redefining the zone to find a more precise entry point that will help me eliminate as much drawdown as possible. So the zone within the zone, the larger base zone, smaller base zone, pulls back to the area right here. We see this 24 range chart. Demand zone resting right here. This is where the break of structure occurred above this area right here. So there's a demand zone resting right here. Now we've got higher, base or higher time frame confluence from the higher base, lower base. Both zones have gaps resting back at them. Increases the probability. After it taps there, we're getting, we're looking for bullish momentum or volume to step into the market. So we get the first closure of the candle here, bullish. You can get in aggressive right here more so, or you can get in aggressive right here at 2056.5 and take a long entry, or wait for the break and close of the next candle and then get in around about 63, 62, whatever the case is. And then once you get that, it's off to the races to the upside. Where to take the trade to? Well, I've talked about it before. I like to aim for at least 20 points, or you can also do a 1-to-1 type trade. Maybe you got in down here and you're looking for a 1-to-1. A 1-to-1 R type trade or 1-to-2 type trade. It just depends, because if you actually get in, if we're getting in off this chart here, let's say you got in at the break of this candle right here. Oops, let's do that again. Delete that. Let's say you got in and we got in here, pull it back here. This is going to be a 1-to-2 right here. So you get in at 60, it goes up to 20,080. That's your 20 points right there. But look how far this thing actually probably went. Let's see. It's probably more so like a 1-to-5. Let's see. Oops. Come on. Yeah, see, this is like a 1 to 5 right here. You're talking about 60. That's a 50 point move right there. We're back up to the VWAP. For a lot of people like to trade that way and take a trade back up to the VWAP. So if we're below a VWAP and then it taps into, say, for example, a high probability demand zone, you can take it back up to the VWAP if you're focusing on that. I like to I talk about picking up the first 20 and then allowing a runner to run. Okay, the purpose of doing that is that you go ahead, you collect the 1-to-1, and then you get out at 20 points, and then you can, once you're out at 20 points, you can let your last contract, like I said, just kind of run and manage the trade. And the way to do that is simply by, for each time it makes a new high or low, you just move your stop up. So once you're into the trade, let's say you pick up the 20 at 80 or whatever the case is, and then this next move to the upside here where you got a swing right here, pushes up, pulls back, and then breaks higher, just move your stop. So if this was my stop, I would move it up right here, the previous higher low that it just made, or the most recent higher low that it just made. And then when it does again, swings up, pulls back, then you bring it up again to the next swing, higher low, and continue allowing it to trail that way by moving your stop up. So and then you're capitalizing off the fact of each time the market makes a move higher, then you just continuously making profit as it moves higher. And at some point, eventually, it's going to pull back and stop you out. But that's the way to lock in more profit. So there's so many different ways and strategies and how you can actually maximize profit. But again, this technique and strategy of how I trade this on a daily basis, using multi-chart confluence from 2 time frames or a higher base and a lower base chart, it works. Not all the time are you going to find, especially I've been noticing lately, say for example, where we get the confluence of both a smaller zone within a larger zone. So the market, we have to adapt ourselves as traders, the market and evolve just as well. And lots of times it's like, if I can't catch a zone on the inside, or there's not one, then I'll wait for maybe a structure break to the upside. When it does tap the higher base zone, so give me a structure break off the lower chart to the upside, inside, or off of the higher base zone. And then so if it does something like this, let's just say we had a structure break. This was a structure break here to the inside, to the upside off the lower base chart. So it did this, pull back, okay, and this is a structure break to where it then pulled back to this key area of demand here. I will take that trade. And the reason being is because it's pulled back, it's broke structure on the lower base chart, okay, higher, but it's pulled back to a demand zone, still resting on the inside of the higher base zone, which is still a demand zone. Again, because this zone here is a demand zone off the higher base chart. So we're still trading off of a pullback within the higher base demand zone, if that makes sense, hopefully. So I just want to break this down to you guys, and you can do your own back testing, forward testing, and I highly recommend doing so. But this is really going to help you in time, build your account over time and allowing it to grow. All right. Using multi-chart confluence or multiple time frames, or however you want to call it. But basically, starting with the higher base chart and then scaling down and moving down to a lower base chart. I'll talk about this scenario and strategy in multiple videos. So spend some time watching the video content. Whatever questions you have, I can assure you almost 99.9% of the time you're going to find an answer within one of the video content or video here on the channel. But outside of that, that's all I wanted to do was share this with you today, and letting you know that for anyone that's really trying to maximize and the profits, regardless of the size of account you have, slow and steady wins the race. We're not here to win them all. You're not going to win them all. It's all about taking high probability setups. So the more confluence, again, you have working on your size when it comes to these multi-time frame or multi-chart setups, you'll do a whole lot better. All right. But for anyone that has not subscribed to the channel, you're a first-time viewer, please take the time to click on the subscribe button down below. You'll see it. Once you do so, make sure to turn your post notifications on so that you do not miss any of the uploads here on the channel. If you're someone that's interested in becoming an elite member, because I get plenty of DMs on the daily, all you have to do, the link is down in the description portion of the video. So scroll down, description portion of the video. You'll see a link right below the Discord link. And if you're interested in joining the Discord, you can click on that and join. But the link that says become an elite member, click on that. and you'll see 2 tiers pop up. Choose the one for $6.99. That's going to give you direct access to the trade breakdown videos that everybody's been asking about, as well as the video playlist and that great video content that I covered on market structure. Okay, because again, market structure is king. It is everything in understanding and knowing which zones to trade and which ones to stay away from. Okay, again, it's only $6.99. Such a very, very small fee. And it's not a course or anything like that. You know, I'm not here to sell a course for a couple $100 or a couple $1,000 or anything like that. I don't do, I'm just here to share with you and show you the way that I actually trade. And all you're doing is supporting my efforts by joining and becoming an elite member. I'm giving something back to you for such a very small fee of only $6.99, but you're reaping the huge benefits if you understand and master how to trade correctly, where you can be on your way to making good money, good profits, like so many traders have that have come to this channel, and join and become an elite member for a period of time. I don't expect anybody to stay there for a length of time or whatever the case is. It's like once you've learned what you're going to learn, or you just move on, right? And for all those that have learned from what I've had to share and are making money of their own, hats off to you guys. I like to see people really become profitable doing this and making a business out of it, okay, whether it's part-time or full-time. But other than that, if you have not, again, subscribe, please do so by clicking the subscribe button. If you found value in today's video content, do me the biggest favor and click on the thumbs up, the like button. I certainly appreciate it. I'll see everyone in the next video. Enjoy the rest of your weekend. Take care.